Welcome to Himalayan Stocks Gurukul, where we guide you towards long-term investment success with market stability.
Large cap financial equities are seeing heavy distribution today. Market makers are offloading positions in marquee lenders like Bajaj Finance and ICICI Bank, driving the bank Nifty down over 300 points. Despite this downward velocity in banking, the India VIX remains at 12.15. The Volatility Index is signaling total market complacency, ignoring the distribution taking place in index heavyweights. An institutional tug-of-war is keeping the headline index afloat. While foreign portfolio managers sold off 17 crore rupees, domestic institutional investors absorbed that supply with a 4,000 crore rupee injection. Is the Nifty 24,500 support shattering, or is this a localized accumulation phase? We look past the headline numbers to see the structural shifts occurring beneath the surface. Headline stability is a mathematical mirage, masking intense institutional friction. The Nifty 50's 0.27% decline is a function of index weightage. The drop is driven by the gravitational pull of massive financial constituents. The National Stock Exchange Advanced Decline Ratio reveals a different story, sitting at a balanced 1,527 advances to 1,502 declines. Selling pressure is localized to specific sectors rather than being systemic. Capital is rotating down the market cap curve. The Nifty Midcap 100 advanced by 136 points, and the Small Cap 100 secured a positive close as domestic liquidity hunts for yield outside of the heavyweights. The broader market architecture remains intact. The selling is contained within the financials. The primary catalyst for the financial sector's underperformance is the central bank's monetary policy. The Reserve Bank of India held the repo rate at 6.5%, confirming a higher-for-longer interest rate environment. This creates net interest margin compression for lenders. Banks cannot easily reprice their retail deposits lower, while aggregate credit growth continues to slow. Unsecured consumer lenders and NBFCs face a sharp valuation derating. Their business models are specifically vulnerable to prolonged high borrowing costs. The central bank's stance on inflation caps earnings growth for the highly leveraged financial sector. Institutional capital is deploying a barbell strategy, specifically targeting high-visibility growth. We see a rotation into large-cap information technology. Cash-rich entities like TCS and HCL Tech provide an operational hedge against currency depreciation and domestic rate plateaus. Institutions are also accumulating automobile stocks. First quarter volume data and new model launches are driving valuation multiple expansion in names like Mahindra and Mahindra. Smart money is shifting from rate-sensitive debt models toward earning stability and domestic capital expenditure. On the global front, foreign institutional investors are de-risking. As United States Treasury yields fluctuate, asset allocation algorithms trim emerging market exposure to adhere to strict value-at-risk limits. Outflows are further catalyzed by tensions in the Middle East. With Brent crude above $82 a barrel, the cost burden directly impacts India's current account deficit and manufacturing margins. But domestic institutional investors provide the counterweight. Retail systematic investment plans funnel billions of rupees into mutual funds every month, creating a price-agnostic war chest. Domestic institutions act as the market's buyer of last resort, absorbing foreign distribution and compressing volatility. Until retail flows show structural exhaustion, systemic bear markets are constrained, supporting a buy-on-dips regime. The India VIX at 12.15 indicates that quantitative models are pricing in a constrained weekly trading range of plus or minus 1.5%. This level of complacency suggests a mispricing of macroeconomic tail risks. The options open interest chain reveals defined institutional boundaries. Sellers built resistance at the 24,800 strike, establishing liquidity zones at 24,400. Institutions cluster in an iron condor trap around the 24,600 max pain level, betting on market stagnation to expire premium worthless. This setup creates a massive systemic gamma risk. If a macro shock breaks the 24,400 support, dealers who are short gamma will be forced to hedge, triggering rapid algorithmic selling. Low volatility environments often precede significant volatility events. The current complacency has set a mechanical trap that could accelerate the next market breakdown. For portfolio allocation, avoid bottom fishing in underperforming consumer lending NBFCs. Wait for the central bank to signal a definitive rate cut cycle. Instead, use index-level consolidation to accumulate secular growth stories in infrastructure, defense, and IT. Fixed income portfolios require a strategic pivot. Lock in peak 6.77% GSEC yields now by extending duration before rate cuts eventually arrive. Success in a range-bound market requires abandoning passive index tracking in favor of bottom-up stock picking. Active traders should avoid carrying unhedged overnight directional positions. Impending global data releases pose a gap risk that standard stop losses will not protect against. The market is repricing debt models and cyclical assets. Stay disciplined and stay profitable. Alpha is generated by respecting structural liquidity trends and hedging against mechanical tail risks.